Hello class, this is Dr. Fenton. In Chapter 12 we're going to see how to analyze financial statements. We've spent a good part of the course analyzing transactions, making journal entries, and preparing all these financial statements. So now that we have those prepared, we're going to see how to compare a company with itself across time and with other companies. Now there are three ways to compare a set of financial statements. You can compare one company against another one. That's the first type. Second one, you can compare the same company with itself over time. And the third way is to compare a company with the industry average. So let's take a look at these in more depth. One way to start analyzing financial statements is to prepare what's called common-sized income statements. In this one, what we're going to do is, when we're working with the income statement, divide each item in the income statement by net sales. So you can see with the red arrow here, we're dividing the cost of goods sold figure of $1,572 by the net sales figure. So this shows us that cost of goods sold is 51% of net sales. And what you will do is use the same pattern all throughout the rest of the income statement. Divide each of these other numbers, gross profit, operating expenses, operating income, and so forth, all by the net sales figure. And then you'll see at the very bottom, net income is 6.7% of net sales. So it's a very simple set of computations. Again, every number in the income statement is divided by net sales, even itself. So when you divide 3,084 by 3,084, you get 100%. You can do this with one company. We did it for Under Armour. You can do the same thing with Nike. Works the same way. Divide all the other numbers in the income statement by net sales. This is a way to compare percentages between companies, because of course Nike, you can see, is a lot larger than Under Armour. So instead of worrying about comparing, for example, net sales of $27 million compared to $3 million, then let's compare percentages. So how well is each company doing compared to the other one? You can see Under Armour has a gross profit of 49% compared to Nike's only 44%. Look at the other numbers, get down to net income. You can see Under Armour, though, only has a 6.7% net income compared to sales figure, whereas Nike has a 9.7%. Doing the same thing with the balance sheet. Again, divide every number in the balance sheet by total assets. So make sure you divide current assets, like it shows here, 1549, by total assets, 2,095, to get 73.9%. To continue, in the property and equipment, divide 306 by, again, 2,095. This puts all the numbers in this column here in percentages instead of dollars for a balance sheet. Again, you do this to compare two companies. So Under Armour, again, is compared to Nike. And you can see that, for example, as to current assets, Under Armour has 73.9 of its assets tied up in current assets, and Nike's fairly similar, 73.7. So they're very similar percentage-wise, even though the actual dollar amounts are quite a bit different. Another way to look at analysis is to use something called horizontal analysis instead of vertical analysis we just looked at. Horizontal analysis compares the same company over time. What you first need to do is have a base year. That's the earliest year in this schedule, so 2013 in this case. Now subtract the later year's numbers by the early year numbers. And so the 3,084 subtract 2,332, and you'll get $752 as the difference. If it was a negative, it had gone down between 2013 and 2014, then you would show this in brackets as a negative figure. But here it's positive, it went up. And now what you do is, once you get the change in each of these accounts, divide the change by the earliest year, not by the latest year. So you divide $752 by 2,332 to get 32.2%. That's the change from one year to the next. So this, you're comparing, again, the same company over time. This is not the vertical income statement where you'll divide every number by net sales. This, you're dividing, you're subtracting the earliest year from the latest year. So again, find the differences, keep up with their positive or negative numbers, and then divide these changes by the earliest year. You can do the same thing with the balance sheet. Again, these are just Under Armour's numbers. So we're looking at 2013, 2014. Find the difference. Divide the difference by the earliest year to get all the percentages. These statements, horizontal statements, again, are just these company statements. It's a way to sort of pick and see if something has changed drastically. And you want to make sure that if something stands out, it's either increased a lot that looks, just odd, or reduced quite a bit. Then you want to explore that further to see what happened in that situation. One number that really stands out here are long-term liabilities. They went from 97 to 323, a change of 226. They went up 233%. That's a large increase for any account. And you will want to track that down to make sure the number's correct at first, and then make sure that it makes sense. So if they went out and borrowed a lot of long-term debt, then yes, it should go up a large percentage. We have a number of ratios now that helps us evaluate financial statements. These are the risk ratios. The first two are called liquidity ratios. We've seen these before back in Chapter 5, so these should not be new to you, nor the next two. We saw these in Chapter 6. So we're looking at analyzing receivables, the turnover and the average collection period, inventory, turnover, and the average days you're holding inventory. The current ratio is another one we have not seen before because we did not cover Chapter 8. But this is fairly easy. Just divide your total current assets by your total current liabilities. And this one is showing you how well is the company able to pay off its current liabilities as they come due in the next year. So the higher the number here is better. As a test ratio, this takes out some of the current assets such as prepaid expenses and inventories. You're looking for more current assets. So here you can see cash, current investments, and accounts receivable are usually the only thing we put in the numerator. Again, divided by the same current liabilities to get the asset test result. We have two solvency ratios, debt to equity. You just want to see how the company is financed. How much debt do they have compared to equity. So divide total liabilities by total stockholders' equity and see what number you get. Times interest earned. This is sort of an odd ratio. You can see the numerator has net income plus interest expense plus tax expense. All that's divided by interest expense. It looks odd. It is sort of odd, but it's really a useful ratio, especially if you're a creditor and you might be thinking about loaning money to this corporation. You want to know how well can this business pay back the interest and, of course, principal later on. So it shows you how well you're able to cover your interest payments. So again, the higher the number is here, the better off you are. So these are the risk ratios. The profitability ratios are next. The gross profit ratio we saw back in Chapter 6, so really don't need to explain this in detail again. We saw these others in Chapter 7, return on assets, profit margin, and asset turnover. Now the return on equity is one we've covered before. This is a very common ratio, dividing net income by your average stockholders' equity. And then price earnings ratio, you want to see how the market feels about this company. So here, this is the first ratio we've seen where we're taking a number and using it that's not in the financial statements. So the numerator here, the stock price, is the going market price of the stock on that day. So divide the stock market price by the earnings per share figure to see what multiple this is. The higher this number is, the more the investing public has confidence in the company. An average PE ratio would be, 10 to 20, I would say, in that range. As you start getting higher, the company has a lot of interest in that business, and they really expect the business to do very, very well in the future. Sometimes you'll see these ratios at 25, 30, 40, 50. And again, it's just the investing public's confidence in the company. Here's an example using Under Armour. It looks like we have a ratio of 69.3, which is a very high PE ratio. Nike, a well-established business, not growing rapidly, but growing in a normal rate, has a PE ratio of only 25. But Under Armour, being a smaller company, and some people think more maybe an aggressive company to really get products out the door, it has a much higher PE ratio. Now the earnings per share figure, they don't have a ratio for it in this chapter, but earnings per share is taking your net income and divided by your average number of common stock shares outstanding. Now the numerator and denominator can adjust a little bit depending on what you have in that company, like preferred stock or so forth. We're not going to talk about that, but just know that your earnings per share ratio, or your earnings per share figure, is found by taking net income and divide it by your average number of shares outstanding. And this is showing you a little question here. What will the high PE ratio indicate? And as I said before, investors have a higher expectation of, and I would add the word strong, future earnings for the company. So that's it. Chapter 12 is very, very short. Just some ratios to memorize and the vertical analysis and horizontal analysis statements to work through. So good luck with your studies.